What are option contracts? Well, a couple of things you need to know. Options trade daily just like stocks do. They have buy prices and they have sell prices. And in America, options are traded on the CBOE in Chicago, which stands for the Chicago Board of Options Exchange. And the way to think about options are stocks trade in New York, options on stocks trade in Chicago. One thing you need to be very aware of, options are bought and sold in contracts. One option contract controls 100 shares of stock. Please remember that. So what are the components of an option contract? Well, there's three key elements you need to be aware of. The first one is the strike price, and that's simply the agreement price. So if you think of a call option, for example, a call option will give you the right to buy shares at a date in the future. The strike price is the agreement price, or the price that you want to buy the shares at a date in the future. The premium is the price that you're going to pay for the option, and the expiry date is the date at which the option contract expires. So here's an everyday example of an option contract. Think about your car insurance policy. So what do you do with that? Well, you pay an insurance company a premium in order to restore the value of your car to an agreed amount if it's lost, stolen or damaged. And that's known as the strike price. The expiry date is the date in which your insurance policy ends. So in fact, every day you're actually using forms of options. So if you buy health insurance, car insurance, for example, there are forms of put option where you're transferring the risk of loss from you onto the insurance company. And in order for you to do that, you're paying a premium. So there's some everyday examples of options that you're already using. So how and where do options on stocks trade? So we're going to show you an example of what a real life trading platform looks like and how the options are priced. So we'll go live and do that right now. So now we're now here in an option quote screen. We're on an online broker, Interactive Brokers, and we're looking at the option chains for Apple. So the first thing you're going to see here is a list of expiry dates. So remember, the expiry date is the agreement date. So you can see we can be buying and selling calls or puts here with expiries right up to January 2018. So let's open up one of these expiries. Let's talk about the 30th of October, for example. And what you're going to see now in a moment is you're going to see call options, which are going to be on the left, and put options are going to be on the right. And in the middle, let's talk about your strike price. So they're saying the strike or the agreement price is 105, 106, 107, 108, 109. So the strike price is in the middle. We won't worry about LTD, it just stands for the date the contract expires, and exchange is smart, and you can see it's the Apple shares. So on the left hand side we have our call options. We have, just like stocks, we have a bid and an ask price. So if we were going to go and buy the right to buy Apple shares at 105 at some date by the 30th of October of this year, we'd have to pay 870. On the other side of that, if we were going to buy the right to sell the shares of Apple, so in other words buy a put option contract at 105, if we thought the share price of Apple was going to fall, we'd pay 243. Moving on down, let's say we looked at the 111 strike. If we wanted the right to buy the shares of Apple at 111, you can see it's 625. And if we wanted the right to sell the shares of Apple by the 30th of October, it's $4 on the right hand side. So you can see here, these are your agreement prices. You can bring in a lot more agreement prices than that, but that's what call options and put option contracts look like on a stock market exchange. It's as simple as that. So just be aware now of what two key terms. One is called exercise and one is called assignment. So if you think about it, option buyers have rights, and when they decide to invoke their rights, they exercise. So for example, if you buy a call option on Apple and in 2 weeks time you decide, okay, I want to actually go and buy the shares at the option price we agreed, that's known as exercise. You're exercising your right. On the other hand, option sellers have the obligation, and when an option buyer invokes their rights on the option seller, this is known as assignment. So the person who you asked to get your Apple shares from have just been assigned. That's what exercise and assignment means. A word on margin here. So margin is a borrowing facility issued by brokers to you. most brokers will insist that you have a margin facility in order to trade options. You will not be allowed to trade options unless you have a margin facility. Now, we would encourage you not to use margin. You'll have to open up an account with a margin facility, but don't use it. Don't use the borrowed money. You don't need to do that. So margin really only comes into play in options when you're naked on put options and call options, and we'll talk a little bit more about that when you get into the advanced option strategies. So for now, just know that margin, it's a borrowing facility that brokers give you. You need to have a margin account if you want to trade options. So any questions in this presentation, please call us.